Now, without any further ado, I'd like to introduce you to our very special guest today, the legendary Greg Lippmann. Greg is the managing partner, founding partner of and chief investment officer at LibreMax, where he's also the chairman of the investment committee. And prior to co-founding LibreMax, Greg was at Deutsche Bank. He was their global head of all non-agency residential mortgage-backed securities, asset-backed securities, and collateralized debt obligation trading. And prior to Deutsche Bank, Greg was the head of ABS, MBS, and CDO trading at Credit Suisse. Some of you may know, Greg was also one of the key figures that was featured in Michael Lewis's book, The Big Short, for his role in having devised a mechanism to bet against the subprime mortgage debt ahead of the 2008 global financial crisis. And Greg, of course, later lived my dream, which is having himself be played by Ryan Gosling in the movie adaptation of the book. Hopefully I could still realize that one. But in the meantime, having a conversation with Greg is as close as I could come. And really on the philanthropic side of the equation, Greg serves on the board of New Victory Theater and South Fork Natural History Museum, and he's also on the advisory council of the American Museum of Natural History. Ladies and gentlemen, it gives me great personal pleasure to welcome the one and only Mr. Greg Lippmann. Greg, thank you so much for joining us.
Thank you, Mo, for the opportunity to participate and, help some small way, contribute to this, important cause and crazy time.
Yeah, no, I appreciate that. So maybe let's go back. Let's start at the beginning. Could you take us through your background and maybe share how you or why did you arrive in financial services, how you got there, et cetera?
Sure. It's actually funny just in how my career worked out in that, I grew up in a family, a small time sort of real estate family, and I thought that I would go into real estate. And as a senior in college, I read the book Liar's Poker, and I thought it was an amazing book. And I decided I wanted to go to Wall Street after I read that book. So and just to finish on that, so when Michael Lewis wrote The Big Short, he said he wrote Liar's Poker hoping that people wouldn't want to go into Wall Street, and it actually catalyzed a lot of people, and I told him one of them was me. And I intermittently still to this day will get emails from young people who say that they read The Big Short and they want to go into Wall Street and they want to be like me when they grow up. And I forward the best of those to Mr. Lewis and say, you did it again. You wrote another book that made people actually want to go into Wall Street and not out of Wall Street. But anyway, so senior year, I decided I wanted to go into Wall Street, and I went to University of Pennsylvania. I graduated magna cum laude. I had a lot of trouble getting a job because my summer work experience was working at summer camps. So even though I had good grades, I couldn't get a job. I started work at First Boston November 4th, 1991. And every day in the elevator, there was mirrors in the elevator. I looked in the mirror and I said, today, Greg, you're going to impress somebody with how smart you are or how hard you work. And I kind of still say that every day. So I think I have a little bit of it because I graduated unemployed. I have a little bit of a chip still that drives me. But that's kind of how I got into Wall Street.
So like going from unemployment to one of the more renowned hedge fund managers in the business, obviously you've had a fair bit of success along the way. To what, other than that humility and that hunger that you bring to bear, any other traits you would, or values you'd attribute your success to? And when you think about the people that you hire or the people you want to work with, what kind of traits do you look for in those folks?
Sure. I think humility and hunger are super important. I think, hunger drives a person to work hard, and humility hopefully helps you to not make mistakes because you're not too overconfident and you look at other things. The people I look for sort of the same thing. I think the other thing that's really important is common sense. It's sort of a funny thing to say, but there's a lot of very smart people who aren't that successful because they sort of sometimes miss the important points. And so I found that there's not necessarily a huge correlation. Perhaps, hopefully in my case there is, but in a lot of cases, there's not a correlation between success and brains. It's more sort of simpler things. And so I'm looking for people that have, more common sense than just smarts.
And Thank you. And as you think about your own experiences that have shaped you, and you look back on your whole career, is there any particular experiences that you could point to as being most instructive, most impactful? Um, Maybe there were success stories, maybe there were enlightening mistakes, maybe there were profound challenges. Anything in particular come to mind?
If I, thinking, so this is more in the lead up to coming to found LibreMax, I guess I would say, it's sort of the hard work, the humility, intellectual curiosity, and a willingness to, be different. I think one of the sort of general views about, Wall Street, or probably a lot of businesses, is most of the time things are fine. It's much easier to be wrong with everybody else than to risk being wrong different from everybody else. So you have a lot of times people don't want to think creatively or differently, and having this sort of courage to do that, as well as obviously the wisdom and the acumen to see that was a strength. I think at times, was a weakness for me as well. I think, one of the reasons that I'm better served at a place like this, a smaller place that I guess where I'm sort of the controlling person in addition, in a big bank, in a big organization, politics are rewarded generally more than independent thinking. You've got to be an independent thinker and be right quickly. So I think, my willingness to be different and be okay with that, was a strength, and not, I thought that this short was a great short. I thought that was the case in the fall of '06, and it didn't really work. So in the fall of '05, and in the fall of '05, and it didn't really work until February of '07. So I was kind of wrong for 15 months, and that's a long time to sort of be called Chicken Little and Bubble Boy and whatnot, and maintain convictions. So I think having the ability to create convictions, be willing to think differently, and have sort of the mental fortitude to stick with it is important. Now, obviously, no one is infallible, and knowing when you're wrong and acknowledging being wrong is also really important. So it's not just have an opinion and be obstinate about it and never change. That's also not really a pathway to success. So I think, that would be my answer.
Yeah. And so I want to actually dig a little deeper there, but I want to come back to the contrarian and your ability to think independently, and how that might be relevant today. Let's take one step back, and just when you started your firm, LibreMax, like what were the overarching objectives at the time, and perhaps you could even share some of the big learnings or surprises that you had in building the firm.
Sure. So I had reached a point at the bank where I felt that my skills weren't appreciated enough, that there was a little bit of like, well, you got that one thing right, and everybody else was wrong, you were right, but you were kind of a jerk about it. And or the analogy you say is like, I thought I was Mickey Mantle, and I felt that they thought I was Roger Maris. And so it was time for me to sort of do something different and start the company. And I felt, first of all, that I have a lot of pride and a lot of energy. And I have, at the time I started the company, I had only 2 children. I have 4 now, but I had young children, and I wanted to work for a long time. And I was committed to putting a lot of my own money into it. So it was really partly a vehicle to increase, on the returns on the fund, my own money, partly a view to sort of show Deutsche Bank that I am Mickey Mantle and not Roger Maris. And partly I felt that, I'm kind of in the sales and trading Hall of Fame, right? Like, I was played by a movie star in a movie, like I did something, reasonably notable as in sales and trading, investment banking. So the hope was like, well, maybe, I guess Michael Jordan wasn't able to play baseball, just basketball, but could I also somehow be in the hedge fund Hall of Fame too someday? So the goal was to create a business that was enduring. We're in business about 12 years now. Was enduring and generated returns for investors, and had a certain amount of AUM that I could maybe someday be a small part of the hedge fund Hall of Fame. Never going to be George Soros or Stan Druckenmiller, but that was, I guess, the goal when we started it. And then your second question, I think, was, how are things different? I mean, it's really different. I was 10 years at Deutsche Bank, and before that 10 years at First Boston. owning the desks is totally different than, working there and feeling you have responsibility as an employee, but as a fiduciary for investors, it's a real thing. And when, family offices and pensions give you money, like you're investing the money of people, right? And so someone who's made a lot of money in pharmaceuticals and they entrust some of that to you, it's very personal and real. And similarly, when we get money from a state pension plan, you're investing the money of the bus drivers and the firemen and so on. It's real and it's serious in a way that, working for a big bank, is not real and serious in the same way. And I also have responsibility to, we have 52 employees, right? So like their families matter in the decisions that I make here and whatnot. So when you work at a bank, that's not really, you don't control the whole situation and decisions. And like, it was a big deal when we first, like this desk, like I own this desk. And if this company, closes, like we're going to sell this desk for $50 or whatever. And that's my $50. And you work at the bank, you own nothing, none of it is yours. So it's a huge difference. And I didn't appreciate all of that day one. I appreciated pretty quickly that I paid for the desk because I knew how much we paid for the desk. But some of the other parts, and obviously like really appreciating the fiduciariness, like day one is hard to do that, right away, just because 20 years of like, working for a giant bank is different.
Yeah, no, for sure. And when you think about the obviously you've had a personal shift from sort of a large corporate environment into a more entrepreneurial one. But there's also over the time that the last 20 years, the investment industry changed quite a bit over the course of your career. How have you seen that change, if at all? And what might you do differently if you were restarting your career today?
Sure. Well, they're really different in that, well, they are and they aren't. I guess the cultural part would be, I started in 1991, was, the very tail end of sort of like the sort of go-go 80s or what have you. And for sure, from like a DEI perspective, things have changed dramatically. It was totally a locker room culture when I started the business, and, progressively, behavior that would be in the same way that you can look at movies. I watched recently the movie Trading Places with my family, and, there are things that at the time nobody thought were offensive or appalling that are preposterously offensive today. And so similarly, things that went on in the early to mid 90s seem insane now and seem, really, really wrong behavior. At the time, it was just sort of locker room banter, to use a pejorative term that's been used by others. So that's changed a lot for the better. Certainly the business is way more diverse from there's more women, there's more minorities, there's more, people that don't fit the sort of standard, fraternity boy attitude. The business also has, become much more commoditized. Information is so much easier to get. I mean, Bloomberg was really just starting when I started in the business. And so information in general is much easier for people to get. So some of the trades that I did in the early mid 90s that were just sort of information arbitrage that just weren't as apparent, just required hard work to determine stuff that other people didn't see. So much of that stuff is so much easier to acquire now. So I think the businesses have become much more systematized. There's much more quantitativeness to it and less sort of qualitativeness to it. I mean, one thing that I'm happy about is with the niches that we're in, sort of structured products credit, is among the least commoditized things out there. There's still a lot of, it's an illiquid market that there's information edges that a person can get in a way that, when the Fed says something now, some bot immediately buys or sells the 2-year treasury or the dollar yen in a way that in the old days, some of the macro legends had much more of an edge because it was, they could figure that stuff out faster than other people. And I think that part of the business is different. So things I would do differently for myself, and when it was my history, I would have been much more careful with emailing than I was, because a lot of my emails ended up in colorful emails, ended up in the Financial Crisis Inquiry Commission and whatnot. So I would have been more thoughtful about not, the CEO of Deutsche Bank never wrote an email, I was told. And actually after the sort of like during the time where I made a lot of money for the bank, I got an email from him, congratulating me, and I replied, which he didn't reply to. And I talked about it. It turned out one of the guys who worked for me in London had been when he first got a German fellow, when he first got out of college, he was one of the people whose job it was to read the CEO's emails and reply and call people on his behalf. So he never wrote an email ever. So I did not follow that policy. And I wrote a lot of emails that, with the benefit of hindsight, I wish I hadn't written. I also like to do things differently. I would have learned computers more than I know them. I graduated college in 1991. I didn't even own a computer. When I graduated college, I didn't know how to turn on a computer. I borrowed my friend's word processor to write my term papers. I didn't even have a word processor. I had nothing. I had a typewriter. So a few years later, people knew computers, but some people my age knew them. So I think that I wish I had better sort of programming skills and C++ and other stuff that I don't even know what it's called that I have.
All right, let's, you mentioned that you're kind of in the structured credit space, and it's a good segue to describing what you do. So could I ask you, assume that somebody does not understand your space, or maybe if you were describing this to your kids or your kids' friends, how do you describe your company's role in the kind of the asset management ecosystem? And how do you describe what you do to others?
Sure. So I guess I'd say I would describe us as a securitized products multi-strategy fund. And so traditional multi-strategy fund would be a fund that does invest across high yield and emerging markets and structured credit and whatnot. And someone sort of sits on the top of that and says, okay, let's put more money here or more money there. And they're looking for the best opportunities across these markets. We only focus on structured credit, but I sort of sit on top of that and say, let's put more money in CMBS or CLOs or et cetera. So that's one part of the answer to the question. I guess the next would be, what is structured credit? So in a simple term, structured credit is a pool of loans that have been committed to a trust that issues bonds against those. And the simple way I would describe it is, if you think about a securitization, it's like a soup. And inside that soup, there's a bunch of ingredients that all went in, and each of those ingredients is a different loan. They're all mixed into the soup. And when you serve the soup, you can't disaggregate which loan is which. You just, as an investor in that securitization, you get your payments. But the way the securitization works is that there are different classes of bonds, a AAA, a AA, a triple B, et cetera. And so my analogy would be, if there's a hole in the bottom of the barrel of soup and some of the soup spills out onto the floor such that there's not enough soup to give everybody a bowl, there's certain investors who get the last bowl. And if some of the soup spills out, they don't get any soup. And there's other people further up, like they definitely get soup. And so the person who buys the AAA bond might be a bank or an insurance company. And they say, hey, we're happy to get a low yield. We just want to make sure that we get fed. Right. And then the middle part would be more likely like a mutual fund who might say, we want a little bit more return, but we're willing to take a little bit of risk that some of the soup falls out the bottom of the bowl, and they would buy the sort of triple B. And then hedge funds that are looking for more yield, more return, say, I'm willing to take some chance that I don't get any soup at all, but I want a big return. So it's our job to understand the collateral and the structure of the deal, i.e. the likelihood that there'll be a hole in the barrel of the soup and how big that hole will be relative to how much has to leak out of the bottom for us to not get our money back, if you will. So we're thinking about the types of collateral. So i.e. is this collateral more likely or less likely to cause a hole in the bottom of the barrel? The structure of the deal. So what can make the deal pay the soup more quickly because, oh boy, the soup is leaking out the bottom. We better start giving people bowls before there's all the soups on the floor. So studying through all of that to sort of figure out which deals make more sense for us to buy, which ones are priced, too cheaply, which ones are priced too expensively, if you will, and sort of going through all that. And the magic of securitization is you take a pool of loans, and if you can ultimately, let's just say the loans are a bunch of mortgages on people's houses, and those mortgages pay 5% interest, similar to switching from soup to pizza. A pizza parlor buys the dough, the cheese, and the sauce, right? And if they can sell the slices for more than the ingredients, they have a business, right? So when a bank says, we have a pool of loans and they're all 5% loans, and obviously some of them are 4 and some of them are 6, but for simplicity's sake, they're all 5% loans. If they can sell the classes of debt in aggregate at a lower interest rate than 5%, it's a business, right? So we're buying the one that might yield 9 or 10%, which they're okay with because they sold a whole bunch of it to a bank or an insurance company at 3%, right? So they know that a piece of it is higher than the interest rate of the loans, but there's a business when most of it is lower than the interest rates of the loan. So we're going to look across residential mortgages, and there's a lot of different things within residential mortgages and commercial mortgages, student loans, CLOs, credit card receivables, all manner of receivables, even, when when there was the big lawsuit against the tobacco companies, the lawyers, they wanted their money now. And basically they were going to get their money over time based on cigarette sales from the tobacco companies. They securitized their future pledges to receive those legal fees, and they got their money right that day. So really any pool of receivables can be securitized. I mean, there's now a big business in securitizing music royalties, so that every time, a David Bowie song is played on Spotify, his estate gets, a half a cent, and then that half a cent is now securitized into these bonds. So we're looking at the types of collateral and the structures and seeing where we think things are priced cheaply. Because they're so different and somewhat less liquid, and there's a lot more work required to understand them than corporate bonds, they typically trade several hundred basis points higher in yield than a typical corporate bond. So like our current portfolio yields over 10%, and it's probably about a double B credit on an average basis.
Fascinating. Now, first of all, I love the analogy. It's the first time I ever heard somebody provide an analogy that sort of made sense on structured credit. So if you could just, and I know this is perhaps obvious to some, but could you go back to the comment that you made about the information asymmetry that you have in your strategy in structured credit as opposed to some of the other strategies and asset classes? And could you unpack perhaps what makes somebody a better structured credit asset manager versus somebody that's mediocre or worse? Like what kind of information asymmetry are they able to capture, and how are they doing it? Are you doing it, et cetera?
Sure. I mean, it's a bunch of different pieces, and if I don't answer the question fully, definitely re-ask it. Sure. One example is, each bond is unique, right? Or maybe not. Each securitization is unique, right? It is backed by a specific pool of loans, and while at a high level, it's macro in the sense that these 500 loans shouldn't perform massively differently than the 500 loans that were securitized by Wells Fargo in May probably aren't that different than the 500 loans securitized by Wells Fargo in June, although they might be somewhat different than the ones securitized by JP Morgan, and massively different than the credit card receivables securitized by JP Morgan. But within the mortgage bonds, they may not be all that different, but what they are is they are different, right? So what it means is, unlike, say, the equity market or the treasury market or the currency market, where if Facebook stock is going up or down, or the dollar yen is going up or down, that everybody knows about that. It's very visible, right? So there's no sort of, did you see what happened to Facebook stock, right? Because it's completely there. But when someone wants to sell a very specific mortgage bond or structured products, the only people that know about that are the people that they tell, right? And so there are situations where, there might be an insurance company in Japan, and they're speaking to an investment bank, and that investment bank is only calling the 3 people to say, hey, it's quarter end, we can't buy this for position, but it's a really important client of ours in Japan, and they've mandated us to find a buyer for it. Do you want to buy it or not, right? So that is an opportunity where only a small number of people are seeing it, as many people as the investment bank calls, and maybe that's 1, maybe that's 4, maybe that's 14, but what it isn't is 400. So there are situations where if you've structured your firm in a way where you have relationships that you're going to get those kind of calls, that's the first sort of level of edge, right? So that would be, when I was at a bank for 20 years, we knew when I had that exact opportunity, I would tell the salesperson in California, you can call this guy, but not that guy, because that guy's been good to deal with, and we like him, and we know that on the way he'll sell it back to us. If he makes a lot of money on it, he'll give us a chance to buy it back from him later. And the other person's always very difficult. Don't call them, right? So now the other person might say, hey, we maximize every single trade to the penny. And I would say, yeah, but you see less trades as a result. So our philosophy is we want to be a place where people want to call us. And we think if we leave a little meat on the bone every time, we get fed more often than if we sort of, squeeze. So part of that is a philosophical view and a view that we want to have those kind of relationships. The next is, being somebody who can respond quickly. So that means having the analytics to sort of be able to run that. And I think one of the other reasons that structured credit is an interesting place for an investor is there's a lot of expenses to do it, right? We have to buy lots and lots of loan data. We have to have a team of people who are quants, people who can build these sort of models that you can parse the loans and quickly sort of come up with, in using AI and things like that. What is the likelihood of default? What is the likely default of this pool and the timing of those defaults and prepayments? And what does that mean for these bonds? So like, if you're not managing at least 500 million, it's really difficult to do what we do at all successfully, because you can't afford all of that stuff, right? So whereas equities, you can be sitting at home in your apartment, reading Barron's, looking at 10Ks and picking stocks. And if you're good at it, eventually you're managing tons of money. And a lot of the legends are people who started with very, very small amounts of money and did great. And I'm not saying they don't deserve it. They 100% deserve it. But our business is not one where somebody can do that. You right. Really need to be able to raise hundreds of millions of dollars first so that you can do that. So I would say one is having the relationships, two, having the analytical team that you can parse quickly and that people know, hey, if we show this to these guys, they'll be able to give us an answer quickly. And what I say to the team is, if we're not interested, tell people right away. Don't, this is not going to be a fit for us. Don't wait on us. But so that, does that answer the question?
Yeah. No, absolutely. And you mentioned, I imagine if structured finance and structured credit is actually, providing alpha to those that are able to capture those opportunities, more people are participating in more traditional areas of structured credit. And there are probably new areas that are emerging. I mean, you gave the kind of example of credit card financing or legal sort of advancing those legal fees. What unique areas of structured finance are you most excited about today? What are you seeing in the market? And then we'll maybe take it from the world of credit, and then we'll elevate the conversation to broader markets and kind of the broader context of the macroeconomic regime. But maybe just starting with structured credit, what's most interesting to you today? What's most innovative? What's unique about the market today and perhaps wasn't there 5-10 years ago?
Sure. Look, I think you always want to balance the, things that are new and novel generally trade cheap because they're new and novel and not as many people looking at them. The downside of that is they're not necessarily liquid because they're not everybody looks at them. So we always want to balance the sort of novel with liquidity, particularly depending on which fund of ours we're talking about. Some of our funds, have quarterly liquidity. Some of our funds are completely locked up. On the locked up fund side, we're looking to do lending that's sort of pre-securitization lending. Really what's exciting there, I guess, is taking advantage of post-GFC regulations on banks became much more stringent. And some of the sort of mezzanine level of risks that banks used to lend to finance companies are really expensive from a capital perspective for them to hold. So there's a niche for us to sort of do the sort of 65 to 80 cents on the dollar or loan to value ratio loan that the banks used to make. They'll make this sort of 0 to 65 cent. And then they used to make the 65 to 80. We now do that. That's difficult to put into, and those will trade 500 basis points more than an analogous CUSIP, than an analogous bond that trades in the market. And so you can feel great about, I'm taking the same risk as something that's sort of validated every day by a trading at 5% higher yield. The downside of it is it's completely untradeable. So that is not something that fits in a hedge fund. That does fit in sort of our private credit vehicles. On the hedge fund side, we will occasionally look at sort of legal settlements and other sort of innovative things. We've done some interesting financings for solar credit, sort of taking advantage of what we think is, an increasing interest in green related assets. But right now, what's most exciting to me on the structured credit side really is things related to CMBS and commercial real estate. There's a lot of uncertainty about valuations there. And ultimately, when the way to sort of generate, differentiated alpha is to have a different opinion, right? If everybody thinks the same thing, there's really no alpha because it's already all priced in. And so what's interesting about commercial real estate right now is there's a lot of uncertainty, right? There's a lot of uncertainty about office valuations in sort of a world where more people are working from home. What are these offices worth? My mom never used Amazon before COVID, and now she uses Amazon. So what does that mean for retail in the long? Like, did we accelerate years and years of the gradual erosion of retail for Amazon? Did that get accelerated because of this? hotels, people travel less now. Even post-COVID, it's going to be a situation where somebody used to go 4 times a year to see a client. Now they're going to go 3 times a year and Zoom once, which they never would have done before. So there's a lot of uncertainty about the valuations of commercial real estate, and uncertainty creates opportunity. And so we'll look at 4 bonds that are trading at 70 cents on the dollar, and we'll think, one of them is worth 85, 2 of them are worth 70, and one's worth 55. And so obviously we'll buy the one that we like. And interestingly enough, some competitor of ours might think the one that we think is worth 55, that's the good one. And time will tell if they're right or wrong. But what's exciting about that is when there's significant differences of opinion, there's the possibility for great returns, because everyone, oh, your bond is crappy. And we think actually, we have reasons that we think that ours is going to be okay. And it's an example, when you asked before, really of where you can do extra work to get stuff that value you can create, see value that other people don't. So it's not just looking at the tenants in our building, it's looking at the tenants in the buildings across the street and how healthy are the buildings across the street, and developing relationships with leasing brokers, and sort of say what's happening not only with my building, but what's happening with it, because if the building across the street has big vacancies, it's going to impact whether the tenants in my building, switch to that building or what have you. So that's we can only do that level of work on a handful of bonds. We can't do it on all the bonds. And so whether other people are doing it or not, they're not doing it on all the bonds either. So what we use is we use the analytics that we have, the sort of loan level modeling, to sort of give us an idea of which bond should we focus on, which bond should we ignore. And then we try to do deep work on those small subset of the possible things we can look at. So part of our success is based on figuring out which opportunities are a good use of time, which aren't. So which things are super competitive, maybe we skip those. Which things are less competitive, look at those. Which things then is our models giving us a good idea of, ignore this one, focus on this one. But that's really work that not everyone's willing to do, or even someone's willing to do it, but they didn't choose to do that level of work on the one we looked at. They choose to do that on the one that we ignored, or what have you. And plenty of times you do the work and you say, I shouldn't buy this. It's not like every time you do the work and it turns out it's gold. Sometimes it's, not gold.
And so, look, you've spoken a lot about the sort of security level analysis at the bond level, and you've also talked a little bit about sector, or, call it commercial real estate as an example. How does the macroeconomic context factor into your analysis? How are you thinking, if at all, about broader markets today? And how does that inform your thinking?
Sure. I appreciate the question, because I love to think about macro and whatnot, and I consider myself sort of a big thinker. And I remember, one time being at an event and with a child of mine, and there was another child there, and their father was a Greek guy who was a somewhat prominent long-short equity hedge fund manager. And I was back in, I think, 2013. I was very excited because I was like, I'm going to, while we're watching our kids, I'm going to ask him about the Greece situation. Like, hopefully he'll have some insight for me, because I'm really thinking about Greece and I'm worried about Greece. And he said, I buy the 40 stocks I like, I short the 20 stocks I don't like, and I don't think about anything else. Which I found incredible, because I was like, remembering 2008, when things go wrong at a macro level, correlations go up, right? And if you think about, there were prominent people who, I speak ill of anyone or whatever, but like people who thought that some parts of were like, they thought Lehman Brothers was going to go bankrupt, and they didn't make money that year, right? So that was like, they got the micro call right, which was that Lehman Brothers was going to go bankrupt. But like, if you thought Lehman Brothers was going to go bankrupt, why were you net long anything? Because like, if that's going to happen, it's bad, right? So I think that macro is an important part of positioning our portfolio at the high level, right? So like, when you think about what my role as the CIO is it's first of all to say, hey, our gross and net should be higher or lower. Secondly, what kind of things should we be buying? Should we be buying things that do better when interest rates go up or go down? How much risky bonds should we own versus safe bonds? How much CMBS should I have versus CLOs? And all of that stuff is informed by the macro, right? So I think macro is super important. And I think that there's some big things coming, some very long, and it's really hard to call the end to 40-year trends because they're really well entrenched. But I think that we are in the beginning of a big change in the trends that we've had since the 80s or 90s or since the GFC that, are going to mean that the success that people have seen with certain types of investments are not going to be the next 10 years are going to be not at all like the last 10 years. And if you look at the S&P's returns the last 3 years, and since in particular, and since the GFC, they're well in excess of what they were with the long term. In the long term, stocks always go up, although we've certainly seen that there's been long periods of times where stocks didn't go up. But stocks have sort of, it goes back to that information issue, that the information has been so pervasive and people know that stocks always go up. So some of the return of the future has been sort of been carried forward to the present. And sticking with the macro, we've been in an environment since the GFC where the Fed responded to every bout of volatility with more liquidity, right? The Fed has been a source of dampening volatility. They've been a source of increasing financial asset return and sort of not so much real assets. If you look at since the GFC, the GDP hasn't gone up that much, but the stock market has exploded, right? And that's because rates have stayed very low. And I'm sure people remember, the mantra, banks got bailed out, we got sold out, right? Which was that the Federal Reserve bailed out the banks and regular way people, struggled. And the response was, hey, trust us, if we had let AIG go bankrupt, it would have been much worse. And no one knows if that's true or not. And yeah, the wealthy have gotten a lot richer because of our policies, but it's also been good for Main Street. And that was a line that one could take, rightly or wrongly, but could take with confidence as long as inflation stayed low, right? And now that inflation is higher, it's becoming more the case that these policies are beneficial to financial assets and to the wealthy, and they're actually deleterious to Main Street because 90% of the stocks in this country are owned by 10% of the people. So most people, it doesn't really matter if the stock market goes up. It matters if their income can afford milk and eggs and bread. And as inflation is soaring, I think we're going to enter a period of time where the Fed is not going to be able to be a source of lower volatility as they've been, but they're going to be a force of higher volatility because of the uncertainty about raising interest rates and whatnot. So I think, and it's a little bit self-serving perhaps, but I think we're entering a period of time where traditional financial assets like, growth equities and whatnot are going to do less well. Real assets are going to do better. And, what we invest in is sort of in between. We're investing in real assets in the sense that it's real estate, it's people's homes, but it's not pure real assets. It's not a copper mine or what have you. But, but I think that at a macro level, things are changing. I think the long period of disinflation and globalization is changing. And again, these are long-term trends, but, COVID certainly made people think differently about where we should make things. The increasing bellicosity with China is making things happen. There was even that when the Suez Canal was closed for a couple of weeks, maybe we can't keep making things. And, recently Intel announced they're making a huge factory in Ohio and they're making a big factory in Germany. And they specifically said, we don't want to rely so much on Asia anymore, right? So for 40 years, we've been in a macro environment where companies sought out the cheapest place to make things. And the result of that was corporate profits went up and payrolls in America were stagnant. Right? Because it's like, we don't need to make this in Ohio. We can make it in Vietnam or whatever. Right. And that was great for the profitability of Intel. And it was not so good for wages in this country. And now that companies are starting to say, hey, we need to make things here. I think you're going to see a time where corporate profitability is going to be sacrificed to an extent for more security of supply chain, more sort of certainty of, hey, if we make it here, we don't have to worry about sanctions. We don't have to worry about supply chain. We don't have to worry about any of that stuff. And there'll be some amount of increased prices and inflation, and there'll be some amount of decreased profit margin. But at a macro level, I'm nervous about inflation and the changing policies as it relates to financial markets broadly in the economy in terms of when the next recession is coming. But I'm really excited that I think that structured products, which have been sort of a diversifier for years, but generally speaking, a laggard compared to equities and private equity and more levered things, are going to be a strong, are going to be a very strong relative performer. It reminds me of the 2000 to 2002 period, which was a period of time where there was the last sort of stock market correction that was with a sort of, minor recession. That was a period of time where structured products did great relative to equities. And so I've been sort of wandering in the wilderness since then, or since the GFC. In the perspective of the product was, a sort of stable, high singles, low double digit yield in an environment where people were chasing 20+% returns, which we couldn't generate.
So I want to dig into that a little bit. So first of all, I'd love to understand how we talk about inflation but right now it seems from what you're saying that it's high and climbing, and there's an unusual combination right now of like rising input costs, supply chain issues, labor shortages, still digesting this large increase of the money supply that you referenced. So it feels not just like any one of these things could be inflationary, but the aggregate of them, almost like a perfect storm. How do you see that playing out? And then, so that's number one. And number two, you mentioned that this could be opportunistic for the structured credit space. So like, how do maybe if you could just elaborate a little bit more, how does it either protect against inflation, the strategy, or what opportunities does it present? Does inflation present? Does this strategy what opportunities does inflation present for your strategy? If you could, those two things, how is inflation different and how are you protecting against it or opportunities it presents?
Sure. So, I mean, I guess the first one, it's funny, we're having the conversation now, and I think no one is talking, I was having debates with people like late last fall and, into December, is inflation transitory or not, right? And I was like, it's not transitory. And, it's transitory. And, once we sort of work the kinks in the supply chain, get worked out, everything will be fine. And I think no one is talking about that now. It's just a question of when is it going down and how much is it going down? My view would be we're not going to stay at inflations of 7 or 8%. I think that isn't really sustainable. And there are some things, supply chain issues that can be worked out, but I think we're entering into a period where inflation is going to be more, 2.5 to 4%, which is very different than, 1.25 or what we had before. And that's going to be an environment where rates are going to need to be a lot higher, and higher interest rates is generally not great, in particular for sort of long dated assets, that are discounted. Think of like a Tesla or whatever, where you say, well, they're not going to make money for a long time, but if you discount the future earnings at zero, it doesn't really matter, because eventually they'll make money, and it doesn't matter how long it is from now. So I think that a higher interest rate environment is generally not beneficial to sort of longer dated growth equities. And, as a bond fund, a higher interest rate environment, all else equal, means our portfolio will yield more, right? So if we're buying things at a certain spread to treasuries, the treasury yield goes up by 2%, our return, all else equal, goes up by 2%. So I think, I think that inflation is sort of going to not go back down. And some of that is because of all of the money that's been pumped into the system. Some of that is, the change that we talked about, that like supply chain is going to be made here instead of there. Some of it, I think, is a rising, DEI movement, which is really sort of saying to people, we need to pay people more. President Biden has a task force that says that's tasked solely with how do we increase union membership in America. Right, you're seeing a drive for unionization in Starbucks and Amazon. Even it's an anecdote, but there was a little bit of a hullabaloo that the Super Bowl dancers should get paid. And for all the other Super Bowls for this one, they just got to like be on the field with Beyonce, and they could put on their resume that they danced the Super Bowl, but they got paid not a penny, right? And so now this is the first year where they said we should pay these people. And so I think that at some level, the sort of rising social justice movement, which is a good thing, in a lot of ways, I think is taking on some momentum to increase. We've got to pay people a living wage or what have you. All of these things are really good for society, but it's hard to see how they're positive for corporate profits and how they're positive for inflation being lower. And as it relates to sort of our portfolio, because we are investing in people more than we're investing in companies, like for us, the perfect world for us, right, is that the people get raises and corporate profits go down a little bit, but just enough that nobody loses their job. Our people can pay their debts more, right? So we're not short corporate profitability, because of course, if companies are losing money and going bankrupt, they're firing people. But we're certainly less geared to corporate profits than an equity or a corporate investment would be. So I think that we're coming to a period of time where inflation is going to be higher, payrolls are going to be higher. Now it's part you say, well, hey, the person got a 5% raise, but milk and eggs and sugar went up 8%. So like they're not better off. But what didn't go up at all was what they owed on that house, right? And typical, person's mortgage or rent payment is like 25 to 40% of their income, right? So that part, that 25 to 40% is not changing in an inflationary environment, right? Because they bought their house for $100,000, they borrowed $80,000, they owe $80,000, and they got a 5% raise and milk went up 7%. but the mortgage payment didn't go up at all. It stayed the same. So I think that, you know, an inflationary environment, and then of course in an inflationary environment, the cost of making a new apartment building or a new house is going up, right? Because the cost of labor is going up, the cost of lumber is going up, the cost of copper is going up. So on a replacement value basis, multifamily housing is going to be, you know, maintain its value because it's harder to build new ones. The country is structurally, you know, there was too much building right before the GFC. I think, you know, the average, we need to build like 1.2 million houses a year to sort of keep up with replacement value and growth of population and whatnot. And we built like 700,000 a year in the 10 years after the GFC. So the country, you know, we woke up all of a sudden, we're like, wait a minute, we were complaining there was too many houses back in 06 and 07. And then 15 years went by and now there's way too few houses. So I think in an inflationary environment, housing is going to maintain its value much better than equities, as an example.
And like, look, speaking of inflation, I mean, we can't really ignore what's happening. Other than all the other forces we talked about, we can't ignore what's happening in Ukraine and Russia. How are you thinking about that? Obviously, the humanitarian crisis speaks for itself, but from a financial point of view, I mean, all of the input costs, you know, medium and longer term, what impact do you envision that having on markets, and how are you participating or not in that?
Sure. It's a great question. I think, you know, not first and foremost, but I remember, you know, I graduated, as I mentioned, I think at least twice, if not three times already. I graduated college in 1991. It was right around the time that the Berlin Wall fell. And there was a lot of talk in the early mid 90s about the peace dividend, about that countries were going to spend less money on their military and they could therefore have lower deficit, which would be lower interest rates, less inflation, and they could spend more money on highways and fiber optics and whatnot. And the peace dividend was cited as one of the reasons for the great period of time during the 90s. I think we're about to have something that I would call the war tax, you know, the opposite of the peace dividend. You're already seeing Germany, Norway, and Sweden. I think they're the three countries, definitely Germany, said we're going to spend 2% of our GDP on military now. Germany's been spending 25 to 50 basis points of their GDP on their military. So they're ramping up their military spending. So in the short run, is that good for growth? I guess so. Having, you know, a million bullets hopefully sitting unused in a warehouse is not in the long run good for anything, just sitting there, right? Right. But either way, they're either going to have to run higher debts, which is inflationary and higher interest rates, or they're going to have to reallocate money from more productive pursuits, you know, to re-weaponize. You know, it remains to be seen if it gets passed, but, you know, President Biden's most recent budget proposal has a 10% increase in the military spending. You know, generally speaking, Democrats, you know, want a lower military spending, and that's new, you know, post Russia. So I think that one of the long-term implications of the Russia thing is going to be it's inflationary because countries are going to be spending more money on defense and less money on more productive pursuits. You know, also, you know, we're going to see, you know, I think, you know, I'm very green, or I try to be environmentally, you know, thoughtful and recycle and things like that. But the movement to sort of green energy is inflationary, right? Because it's cheaper to use to burn fossil fuels, or else we would have already switched, right? So that's inflationary. And now you look at like Europe, and Europe is considered greener than the US. And part of the reason they were greener than the US is because they outsourced their energy to Russia, who wasn't green at all. I said, oh, we don't burn any fossil fuels here. You know, we don't mine, we don't do any fracking, we don't do any of that stuff like the US does. And so now with what's happened in Russia and Ukraine, you know, Germany had closed 3 of their nuclear plants last year, and they were scheduled to close 3 more this year. They've already said, yeah, maybe we're not going to close those 3, and maybe we're going to try to turn on the other 3 that we closed. So I think, you know, shifting to a more and less dependent on Russia, as an example, because I think the question was about that, energy part is going to be inflationary, right? Because that was a cheap place to get energy because they weren't dealing with environmental standards and whatnot. So if we're going to produce that energy in Europe, it's going to be produced more expensively than it was here. And hopefully in the long run, you know, solar and green technologies, you know, wind and all these things can be done at scale at affordable rates, but that's not the case now. So in the short term, that's inflationary as well.
Yeah. Yeah, no, I appreciate that. And so we talked earlier about you sort of having some contrarian views and being a non-consensus thinker and being willing to think as an outsider. What do you think are some of the contrarian or unconventional beliefs or opinions that you hold today? And maybe more specifically, what do you think we're doing today, or sort of the investor class is doing today that we'll look on with surprise? Like, are there any specific risks, opportunities that investors are not giving enough consideration to?
Sure. Well, there's the famous adage, past performance is not indicative of future results. But, all you hear about, is I want more private equity. I want more passive. I want two things. I want the S&P 500 and I want private equity, right? Because, we're sort of, we're neither of those things. And so some of this is self-serving, but, when you think about like, what will people look back later, I think, the Fed is raising rates. And, people talk about, when are we going back to a normalized environment? And like, I'm not sure why somebody should define the sort of 09 to 21 period as a normal, like that's just the most recent environment. So I think one thing investors are making mistakes on is they're sort of looking at the last 12 years and calling that normalized environment. Like, when are we going back to the 09 to 2021 period? Why can't we go back to this, 1974 to 1982 period, which was a horrible time for most investments, right? So I think investors sort of suffer from sort of recency bias, and so I think, one mistake is that, and another is sort of looking at, is this specific manager somebody who was the right place, right time, or do they have a flexible, adaptable mindset and able to sort of, change with the times, or are they just sort of, one trick pony, if you will, and what worked, like why were they so successful from 09 to 21? Is it something in them, or was it that this environment was particularly suited to what they were doing at that time? And will they be able to change if the environment changes?
I promised my wife I wouldn't leave this conversation without asking you, how did the Big Short happen? Could like you've mentioned that it sort of played out, but how did the actual Michael Lewis get you on his radar screen? How did that come about?
Well, obviously, you have to start with the short itself in terms of how did I get in the book. But, I consider myself an intellectual, like I mentioned. And when they started to have these derivatives, so started trading in 1994. And you could really only love them or like them because you could only be long this product. There was no way to be shorted. So my decision process was just like, how much of it do I want to own, right? And then in 04/05, they started to develop these derivatives. So there was the ability to bet on no. And I didn't think I'd want to bet on no. I'd never bet on no before, but I thought I should explore if it made sense. And so with the help of somebody, I had a lot of, I basically said, test this theory, test that theory. He had the computer skills to sort of like go through the database of the loans and whatnot. So I said, break out the loans in America by quartile of home prices and how they do. So the top 25% of America was, California, Florida, places like that. And housing prices were going up 14% a year in those places. Now, they were 25% of the loans, but they made up like 60% of the loan balance because the loans are bigger. Houses are more expensive in California than Tennessee. And what was amazing was that over 6 years, even though houses were going up at 14% per year, 7% of the people were defaulting. Even though they had an asset that like over 6 years had like doubled in price, 7% of them couldn't pay anyway. And when they defaulted, you lost like 10 cents on the dollar. Not very much because the house was worth double. But even then, the house was worth twice what the person owed you. And you still lost money, getting them out of the house, mowing the lawn, selling the house to somebody else. But the part of America where it was going up the least, 28% of the people defaulted. And you lost like 50, 60 cents on the dollar. But even there, home prices were going up 3.5% per year. So I looked at that, and these mortgage bonds, basically, the loans were called teaser loans. They had low rates for 2 years, and then the rate went up. And you'd say to the Countrywide and these other places, how can they ever pay the new rate? They said, the new rate? They'll never pay the new rate. We'll make them a new loan. Every 2 years, we'll just make them a new loan. And they said a rolling loan gathers no loss was the term people used. So I looked at this and I said, well, if housing prices ever go up 3% in California, the default rate is going to go from 7 to 28 or somewhere between them. And the recovery is going to go from 90 cents on the dollar to like 50 cents on the dollar. These bonds had about 8% protection. So meaning that if the losses were 16, 50 cents recovery, the bond starts to lose money. And they were about 1% of the whole thing. So basically, if between 8 and 10% of the people defaulted on these properties, 16 and 18% of the people defaulted, these bonds were worth zero. They're worth zero. And betting against them cost you 2% a year. So you're going to lose 2, and then the loan would get refinanced, or it wouldn't. So basically you could lose between 4 and 8 points, and you could make like 100. So he said, I'm getting paid like 6, 10 to 1 to bet that someday houses in America go up 3% a year, which seemed like a pretty reasonable bet. So I went to the bank and I said, I think I should make this bet. And I run a business that makes $200 million a year for you. And I want to bet $1 billion, which is going to lose $20 million a year. So I'm going to take my $200 million business and turn it into a $180 million business. And maybe I'm going to make, $500 million, $1 billion if this happens. So they said, okay. And then it didn't work for 6 months. And they said, well, find some other people who believe what you believe. So I wrote the book about, the different charts and whatnot. And I started to talk to people all over the world, mostly New York and London. You do emerging markets, you do high yield, just spend a little bit of money on my crazy thing because it pays a lot if I'm right. If I'm wrong and everything is fine with the world, you'll make a little bit less than you would have made otherwise. If I'm right and it doesn't affect you, it'll be amazing for you. If I'm right and it blows up the thing that you have, which is actually, of course, what happened, it'll cover the losses on your Brazilian t-shirt manufacturer or whatever it is that you do. And so I talked to about 250 people about it. I got about 75 of them to do it. As the more times you tell your own story, the more you believe your own bullshit. So that's first of all. Occasionally somebody would ask me a question that I hadn't thought of. And like 80% of the time, the answer was consistent with the thesis that I already had. And the more people I got to do it, the more money I was making, getting people in, right? Because I was charging sort of like a commission, if you will, bid-ask spread. So by the end of the year, I wasn't short $1 billion anymore. I was short like $5 billion because I was making enough money. I was making enough money churning other people to cover my negative carry on betting on no. So anyway, we know what happened. It blows up. Michael Lewis reaches out to me and he says, I've spoken to 25 people about this subprime thing. And, 22 of them have fingered you as part of this. So as the person who told them about it, you were the person who told 22 of these people to do this trade. So I'm writing this book and, you're going to be in the book, whether you like it or not. So you could talk to me or not talk to me. That's your choice, but the book's happening anyway. So that was how we met. And, he's a great guy and he's really good at getting people to talk, as you are, Mo, also, getting people to talk. So, he wrote a lot, and how did I feel about it? I think the book is a caricature, of me. It's based in fact, and it's more right than not right, but, he's trying to make something entertaining, and it's entertaining. And I think occasionally some of the facts were exaggerated or ignored to make it entertaining. I think, as it related to the movie, I hoped I would come out better, but it was better than I feared. It was worse than I hoped. I think that Mr. McKay, definitely has a very specific agenda, and he definitely did not want to make Wall Street people look good in his movie. So I think right. I look okay in his movie, so that's kind of a win.
Yeah, you got Ryan Gosling in there. That's a big win. So maybe we'll end with one last question, and I know we're sort of out of time, but best piece of advice or wisdom that anyone has ever imparted on you. And Greg, I know you have 4 kids. If there's only one piece of advice or wisdom that you would sort of impart on them, what might that be?
It's the same. It's what my father gave me, and I guess I would give them, which is sort of humility and never think anybody, treat everybody the same, no matter who they are. And, or if anything, treat sort of people who somebody might think are less, like treat them even better. But so be humble, work hard, never forget where you came from, and and never give up, never surrender. I don't like to hear no. I'll give you just as it related to this. So when I met Mr. McKay, he said, oh, I want to be open kimono with you and whatever, blah blah blah. And he really asked me to use my name, and I said no. And he said, okay, well, Ryan wants to talk to you and whatnot. And he said, he showed me the script. And I said, well, I want to see the script. So I saw the script, and there were a lot of things in the script I really didn't like at all. Like I thought they made me look bad and unnecessary. So I called the lawyer that I had related to the film, and she said, don't bother. Like you have you have nothing. What you signed was, as long as they don't use your name, there's nothing you can do about it, right? And that's just not how I roll, So I got on the phone with Ryan and Adam McKay, and I said, you got to get Michael Lewis on. I read your script, and you got to get Michael Lewis on the phone right now because there's 12 things in here that are ridiculous, and you make me look like a jerk. And Mike, you told me that you were going to be faithful to the book. Michael Lewis, he does not think I'm a jerk. Get him on the phone right now, and we can argue about. And they're good actors, both these guys. They're like, whoa, we're not really sure why you're so upset, and calm down, blah blah. So anyway, so McKay said, look, I want to be respectful of Ryan's time. I want to, I will go through the script with you line by line tomorrow, but right now, can we just answer Ryan's questions, please? So I spent that 2 hours with Ryan, and we went through the script line by line. And, I told him things that I thought were unfair and, were just like ad hominem attacks against me that had nothing to do, like they didn't serve any purpose other than to make me look bad. And so he agreed to change a bunch of them. A couple of them ended up getting edited out, not because of what he agreed to, just it was too long. There were some, I thought, great scenes that had nothing to do with me that were not in the final product. So I think, the lesson of never give up, like the lawyers, like, give up, like, don't bother, don't fight with them. And, if anything, they're going to make it worse because, because they can, they're trying to needle you and they'll make it even worse because you complained. I was able to persuade, not to persuade Adam McKay not to vote for Bernie Sanders for president, but to not think of me as, this evil, vile person. I was just I had a point of view, and, people laughed at me and thought I was crazy. It's not like I tricked anyone into doing anything. The people that were betting on yes, like they thought I was a fool. It's not like I didn't mislead anyone about anything.
Well, no, Greg, that was an amazing story. Thank you for sharing that. Really appreciate it. And thank you for joining us today and sharing your incredible insights with us about LibreMax markets and being ever so generous with your time and your wisdom. We really do appreciate it and hope we could do it again soon.
I'm grateful to support the cause, and I'm flattered that people, given some of your other guess that anybody would actually call in. You have to tell me how many fewer people called in for mine than Stephen Schwartzman's. I'm sure it's a lot.
Listen, this was great. And it's a great segue to thank everybody else for joining us. And if you haven't yet donated, please do so at luncheswithlegends.com. Join us in supporting the good people of Ukraine with the aid that they so desperately need and desire.